So we're going to dive right into it, and we're going to do a roll call, starting with Carey.
Carey Benvenuti, Mortgage Architects.
Great. David Somerville from Capital Wealth Management. We're in the wealth and estate planning practice.
Robert Greatrix. I'm a partner with Wilton Whitehill. We're a CPA firm in North End, Niagara Falls.
Thanks, guys. And obviously, I am Charles Plant, and I am the Elder Millennial Realtor. That's what I'm coining myself as moving forward. So we're going to dive right into it. I'm going to start with, I had a Google form, guys, that I put out there, and I got a bunch of responses on. So we have some real quality information and questions that we can run with. To start, we have the top 5 biggest hurdles for 2022 for first-time home buyers. And this is what people responded for. So number 1 is affordability. Number 2 is debt load. Number 3 is expendable income for down payment savings. Number 4 is kind of in line. It's finances and stability, which are understandable right now.
Yep.
And then number 5, which definitely I am seeing as a real estate agent, is confidence in their buying power. Right now, it's a big issue. So with that being said, kind of setting the table, the first topic du jour is my parents are considering using equity to assist with my down payment. And we're going to start with Carey, down payment strategy and gifted down payment.
So there's a couple of different ways to do this. Obviously, if the parents have, there's a lot of equity that's available in the market right now that we know that we've seen a significant increase year after year after year since 2016. Market just continues to blow up. We have a supply issue here in the Niagara region. So a lot of people are looking to say, how can I access equity in my home? Because I want to be able to help my kids while I'm here, right? So we have a couple different strategies there to help you while you're currently working, or if you've retired, to be able to access equity in your home. And what does that look like to be able to gift your children and help them get that start on their next leg? So whether that's 5% down or 20% down, and I'm going to sort of refer to Rob here as well, because I think if you're thinking about giving your kids equity right now, think about giving them so they can put into an RSP. Right now, that's where David would step in, and it's going to give them a tax offset. So I'm going to let those guys speak to that, but it's a good strategy to sort of help your client, help your kids build a little bit of wealth while they're getting ready, where they can gain a little bit of interest on their investment, as well as maybe get a tax rebate.
Yeah, that's a good point. I mean, that's been the home buyers plan for the RSP has been around for quite a while now. It's interesting, I was thinking about it. You think about your major purchases in life. There was a hole in the retirement planning. So I think that's when RSPs kind of came about. And you could start your RSPs at a very young age, planning for your retirement. So you have this 30, 40-year run of RSPs to help build up. Then education costs at some point got a little out of hand. So there was a bunch of products developed, but then the RESPs were really the main product. Again, a lot of parents started that when kids were young, ran that for 20 some odd years in order to build up the funding for the kids' education. Well, now we're faced with this housing market.
Shortage,
where's the 20-year product that is that going to come out? Is someone looking at something where a government initiative where there can be a 20-year plan to give kids enough to get into the housing markets? Because even the home buyers plan, you think that was $30,000. I think it started at $30,000 or $25,000. Now it's $35,000. Well, those numbers were all created when houses were a couple $100,000, right? Yep. And now look where they are, and now we're at $35,000. It seems like almost like a drop in a bucket, but it's probably one of the better things out there. There's not much else really in terms of product for it. So this home buyers plan, as Carey alluded to, you try to get your $35,000 into an RSP. It's going to create some refunds along the way. Maybe you can do it over 2-3 years. Create some refunds. You can top the refund. Take the refunds as well as take the $35,000 out. It has to be repaid to your RSP over the next 15 years, so you don't get taxed on it as long as you repay it. And it certainly would help, but it seems almost like it's not enough for where the market's gone, in my opinion. You know what I mean? Like, it's not enough help at this point, but it's something that I think you have to look at doing.
Well, I think, just to kind of jump in here real quick, I think Yeah, the home buyer's plan makes some sense, like you said, Rob. I mean,
Yeah.
15, 20 years ago, you could buy a house for $150,000. But the one thing I would say about the home buyer's plan is make sure before you rush down to the bank or rush down somewhere and make that deposit, obviously tax rates are important. You don't want to buy it. Your son or daughter makes $12,000 a year, doesn't pay any tax.
Yeah.
You decide to give your kid $20,000. He buys an RSP. Well, what are you getting that deduction against?
Yeah,
right?
no, that's right.
You can carry it forward. Typically under 50,000, the tax deduction is about 20%. So it would work in some cases. I mean, I think what we're finding right now is a lot of parents are coming in saying, yeah, I mean, I need to give my kid $100,000. And in our world, in the financial world, $100,000 from a 55-year-old's portfolio might make a huge impact in their future, in their retirement. But again, the places that we're pulling it from is, in most cases, a TFSA, the tax-free savings account. That way, mom and dad can take it out. It's non-taxable. Second option might be to sell some shares, some stocks, some bonds, some mutual funds, whatever it may be. And then, of course, the third option is if you have it, if parents have done a good job creating cash value in their life insurance, that's a third option. But again, it's not one size fits all. It's not do this or do this. It's really make sure you get some good investment advice from your planner, your advisor, your accountant, before you go out and make these big decisions.
Yeah, and I think that's part of the frustration is there is no one answer for this problem. It's we're all scrambling to try to get the best solution for a problem that doesn't really have a suitable solution, to be quite honest with you. So I've heard that there is a potential along that home buyer's plan. I did read it's not something that's enacted now, but there is some consideration where parents might be able to withdraw the RSP from their own RSP if the kids don't have it and lend it to their children or redirect it through the home buyer's plan to their children, which is not allowable right now, but it's a step I think that maybe is getting some consideration because a lot of kids don't have $35,000 to put into their RSP, right?
Well, a lot of times too, like some of the ways that parents can help their kids is by helping them pay down their debt.
Yeah.
So if you're carrying a student loan or maybe you're carrying a line of credit, or please don't go out and buy a F-150 and then find out what your affordability, and we're going to get into that as well. But sometimes what you can do to help your kids is by setting them up so like they're debt free. So in our team, we lead with budget first. So who can qualify, what comes into qualification? And it's always, what your down payment is, what your credit looks like, of course, and we can talk about credit, what your income is most for, and like, what is your debt? So if you're coming into this and you've got, a $24,000 student loan, or maybe you're carrying a line of credit, or you just went out and bought a new car because you're living at home and you're like, I have no overhead. I'm going to get myself a car, and that's awesome. I want you to think about sort of like, you can't live in your car, right? Or hopefully you're not going to live in your car. So there's an area where parents can sort of help their kids from a qualification standpoint, because sometimes paying off the debt will help you get into more house as opposed to putting more down.
Right. Yeah, for sure.
Or increase the value, which is something that I had a client recently that we dealt with together, and we experienced that specifically with them, where it was a small amount that was really left owing on a vehicle. And that made all of the difference for them to go from they were just under that spot they needed to get into their first home, and getting that cleared up, just taking care of that one small thing gave them that boost that they needed just to get there so that we could get them into where they needed.
Yeah, and we were able to pay. It was a small car balance. I think it was, I want to say it was,
like 3
it
or
was
4?
I think it was under 3. Yeah, it was around the $2,000 mark, but the monthly payment was around $500. So just paying that off and pulling that away from the down payment allowed them to make the jump literally from like below the 400,000 point to over the $400,000 mark, which like helps them get into a lot more spread of a
Carey,
home.
can I ask you a question? Do you find that when a person comes in to qualify for a mortgage, or mom and dad are bringing in the kid and he's going to maybe possibly hopefully get a mortgage, what are some of the things on their debt that you just say to yourself, why do you do that? I mean, listen, we all need a car. Do we need an $85,000 F-150? I don't think we need that, right? But what do you find are the things that are...
Car loan.
Car loan's the big one, right?
100%. And so, they're leasing a vehicle, which is to me like, I understand the merits of leasing. I'm self-employed, so I have my accountants that usually encourage me to lease because of the write-off strategy. But honestly, it's hard to get out of a lease. So to pay out a lease, there might be a penalty, or you might not be able to get out of it, but they're coming in and we've got, a biweekly payment of $700 a month, plus maybe a student loan that's in there as well. That is just, now you're carrying $900 a month in debt load. And it doesn't feel like a lot because you live at home and your student loan is a couple $100 a month, but now you've got this car loan on top of it. So I would highly encourage you, if you're strategizing, you're thinking about buying a home, whether you're coming out of high school now or you're in university or you're living at home and you're working and you're saving, buy a beater.
Yeah, I want to jump in here and say the top 5 biggest hurdles that people spoke about. The fifth one was confidence and buying power. And that really lends to that whole situation is if you're taking these gigantic car loans and you have all this outstanding debt, it dramatically affects your buying power. And a lot of people don't understand that. And
I don't want to come from a doom and gloom place whatsoever, because our job is literally, we have worked with clients for years to get them from A to B. So just saying, you know what, this feels like it's not going to happen. It's going to happen. And that's what this sort of roundtable is about, is encourage you guys and supporting you on how to get from A to B. And there's zero shame about saying, you know what, I have $20,000 in credit card debt. Let's reverse engineer this. And we work from a budget, and we talk about how you're going to be able to pay down that debt. Maybe we're using a cashback mortgage to pay down some of that debt and roll it into the mortgage, because there is cashback mortgages that are still available, even as a high ratio with less than 20% down mortgage. So there's a lot of flexibility out there, but I like to look at your whole picture and just say, okay, how are we getting you from A to B? And if mom and dad are co-signing, what does that look like for mom and dad as well, right?
So I'm going to switch gears up here a little bit. There was something that was really intriguing in our previous conversations leading up to this. Rob, one point here in this same vein, I think, was gifting funds to children via shareholder account or something, equity.
Yeah, we've being an accountant, we deal with a lot of small businesses. So a lot of the questions we're getting are from small business owners, or business owners, doesn't have to be small business, but there are ways to extract funds from entrepreneurs that have their own corporations that may have a buildup of cash in there. The most obvious one is obviously if the company owes that shareholder some money, then they can withdraw that loan and at that point gift it to their children. And that's the easiest, cleanest way out if you have the ability to do that. But not all businesses have that. So otherwise, you are looking at taking something. There's some provisions that allow you to take some money from your corporations for short periods of time, a year or so. But for long-term solutions, if you don't have that shareholder loan, then you're looking at taxation of the funds coming out either by way of dividend or salary.
So this is more for the parents that are business owners that are brainstorming different ways, ideas to get a hold of some liquidable fund, liquid assets. Exactly.
I mean, there's not, when you talk equity, it's not always in houses. People have equity in their businesses, right? Yep. So sometimes you can access that equity and do it that way. So just another way, if you have a corporation and it's done well and it's got some cash reserves, and something that maybe you want to talk to your advisors about if there's a way to access some of those reserves.
What's the time? So literally knowing nothing about this, this is really new to me. So what's the time frame on that? If a parent said, hey, you know what, I've got $300,000 in equity I can pull out, what is it what's the time frame to access that and then gift it?
Yeah, it's really a pretty easy thing. If it's owed to you in terms of a loan, it's just you're repaying your loan. So it's just really cutting checks and getting it out and lending it to your children. I mean, then from that point on, you have to decide how, as a parent, you're going to, if there's going to be some arrangement to get that back at some point, maybe upon sale, maybe upon remortgaging, once the equity's there in the house. It's always good I think it's prudent to have those conversations with your children if you're doing this type of lending to, if things work out, hopefully they do, and you're able to regain that source of funding, because a lot of times that is kind of crucial for the entrepreneurs, even for people who are doing it with their own houses. Maybe that's a retirement asset for them. So replacing that money down the road is something that should be discussed, and should be planned for.
That's an interesting
point. If I can
point.
just jump in real quick too, so if you're going to do that, let's say you've got a business owner who decides to give his kid $250,000, whatever it is, but he's got 2 other kids. So our advice would be make sure you document it, make sure it's put down somewhere, make sure that the executor knows that not that dad's going to die the next day,
Right.
but the one thing, the biggest way to kind of disrupt the family.
So make sure you give it to the favorite kid.
Give it to the boy. Give it to me, Dad. Just kidding, not to my sister. But no, but you just, again, we talk about, full disclosure. So at least the other two know, okay, what if Dad gave the son $250, didn't give the other kids $250, 3 years go by, Dad has a heart attack and dies. They're winding down the estate.
Yeah.
And then there's a little bit of conflict
Like,
on,
hey,
yeah, but
you got
it's split
250.
1/3, 1/3.
Yeah.
But hey, my brother got $250 up front. So just,
Yeah.
again, writing it down, having some documentation, talking to, your executor,
Yeah.
let him know what's been going on. Just keep it above board.
So-
It's good advice.
And talking about co-signers from like, we get a lot of questions. What does that look like? What's the obligation for me from a co-signing perspective? So that's a common question that comes up because there's this misconception that parents are going to be on the mortgage forever, which seems overwhelming. So I think the number one thing that parents need to know that once that equity is built up, and maybe the kids are sort of starting out at a start-out position within the company that they're with, and there's growth opportunity there as far as income. We know kids typically aren't, hopefully not going to be earning the same amount of money, 5 years later. Yeah. We can then remove the parents from title when we go to renew the mortgage. So it gets just treated as a title transfer. And we encourage the lawyers that we work with to ensure that they're registering from an estate planning perspective as well as from a tax planning perspective. We're registering the kids at 99%, mostly so we can take advantage of the first-time home buyers' lands transfer tax credit, which Charlie can actually talk about as well. But and that we're mitigating any capital gains.
Yeah, that's a good point. I mean, it's a little tricky out there right now in the world of buying and selling homes. I think CRA's got their eye on some of these transactions just because purely the volume of the transactions and the dollar values have just gone up so dramatically in the last number of years. It's obviously something they want to see. So you've heard with the COVID and the debt that we're taking on as a country and potential taxation issues that could arise from this. One of the things is they are looking, I think, at principal residences, and maybe there's going to be something there. Hopefully not. That's been probably the best tax break. Well, it's the best tax break as Canadians that we have. So we hope to protect that. The capital gain inclusion rate's 50% right now. So that I think might be on the table. I've seen that rate at 75% and at 66 2/3%. So that's something they've done in the past. So they have raised that rate in the past. They've toggled that rate in the past up or down. So that I think is probably on the table. I got to think that capital gain rate might more than likely will go up at some point. And parents putting themselves on the deeds when you already own a home, you only allow one principal residence. Now you're on two deeds. As Carey alluded to, there's ways that you just be very careful with
mitigate.
it. Yeah, to mitigate it because you don't want to convert what would be a tax-free transaction under the principal residence deduction to a taxable transaction because there's a parent on the deed. So it's got to be done. It's got to be done with proper advice.
I'm sure from an estate planning perspective, that sort of falls into you as well, right? Because what we want to show is that that there's no, we've got a bare trust agreement in place, and that we can we can show and support the fact that the property was covered by these kids.
Yeah,
and that
that's a good idea.
The kids have been
planning.
carrying the cost from it, and there's no beneficial ownership to the parents, right? So. And then again, if somebody passes away, it doesn't come up like this is part of the estate,
Right?
Because we've been proactive as opposed to being reactionary.
Yeah.
And speaking in the estate, just to kind of touch base on that is, if my 25-year-old son, I'm helping him out, I give him $100,000, we buy a nice little condo or townhouse or whatever it is that fits his budget. My next step is once it closes or when I'm with the lawyer, I'm probably going to look at having a will for him because most people don't have wills. I think half of Canadians, don't have a will. Of adult Canadians don't have wills, and it's now you've got an $800,000 asset. So you die again. I'm not talking about people dying, but things happen, right? We buy insurance because it's insurance, right?
Yep.
But at the end of the day, for $200 or $300, you can do some of these online will kits. They're really good. Yeah, great product. You talk to the lawyer who's doing your real estate deal. You say, hey, listen, you can do the deal. Can you give me a deal on a will for my kid? Power of attorney. God forbid something happens to your child, that's not going to be stuck in limbo, and you've got an executor, and just for a few $100, it's
Well, maybe you could talk about this a little bit as well, because if we have, boyfriend, girlfriend buying a house together and mom and dad are gifting, $50,000, $30,000, $20,000, whatever it is, they're really essentially, although, we know things go sideways, they're really just giving it to their child. So what happens in that respect where they're like, okay, I've given my child this equity that's in the property, but both, partners are contributing equally to the home. What happens if there's a breakup? How is that addressed? And how am I ensuring that my kid is actually getting back their portion of the gift that I've given to them, right?
So it's a great point. Just jump in here, Rob, is, if I were to do that to my son, I would probably do something like a promissory note, which is just, it's a paper trail, right? So if I gave my son $100,000, let's say his partner doesn't put anything into it, I'm fronting the down payment. I do want to make sure that if that
it's going to come back
goes
to
sideways,
him.
I can at some point retract that back. So the promissory note, really simple. You can find them online. It's a simple one pager. But dad give son $100,000 with the intention for him to use it for his house. I can set terms. If I say to him, I want it back within 5 years, I want it back at potentially, I can recall it back within 6 months. If there's an interest rate component attached to it, so be it. And, I could also write in there that if I do die, it's forgiven at death. So it's a simple little one pager. It protects mom and dad. So again, if something happens in that relationship and they break up and they want to sell the house and they both have an equal say in it, I can put my piece of paper up front and pull back my 50 or 100. So it's a simple little.
From a lending perspective, a gifted down payment is a gift.
Yeah.
It's non-repayable.
Yeah.
So we got to keep that in mind as well. But we also want to ensure that we're protecting, if somebody's coming into it. So maybe what you're doing is you're setting up a registration where maybe that, you're giving $100,000 to your son. And maybe what we're doing is ensuring that the registration and the bear trust agreement that gets set up in the beginning, it's set up equally for whatever percentage each person brought to the table. If that's what works for that couple, they might say, we're in love and everything's great and everything's perfect. And you know what, for the most part, everything actually does work out. But we also want to ensure that there's no hard feelings at the end, because this is the sort of stuff, again, you want to be proactive as opposed to being reactionary.
Bill's saying the best offense is a good defense, right?
Yeah, exactly.
A little bit of defense doesn't hurt.
Yeah.
So we're gonna switch gears and touch back on something that you'd mentioned earlier, but I want to just get a little bit more insight into it. Is lending funds to your children using your life insurance cash value as a vehicle?
Yeah, right, Charlie. So again, pretty simple, right? I mean, I have some clients, myself included, that
gifting funds. I apologize.
Yes,
Yeah,
gifting.
exactly.
It's a gift.
We have clients. We have lots of people that have life insurance policies with enormous cash values. Now, some parents might have a $10,000 or $20,000 cash value. Some parents might have $30,000, $40,000, $50,000. So the point is that if they don't want to disrupt their RSPs, they don't want to disrupt maybe their TFSA, and the father says, I've got this policy here. I bought it on my son, as an example. I have one on my son. He's 18 years old, and it's got some cash in it. And let's say in 5 years he decides he wants to buy a house. Let's say the insurance policy is worth $100,000. Let's say the cash value is worth $25,000. I can then just change ownership to my son. He can then extract the money. Be careful. Talk to your insurance advisor about any tax consequence. Mm-hmm. But again, it's a way for him to pull some money out, use that as his down payment. That's an option. If it's my policy, then obviously I can do the same thing. Call your insurance advisor. Ask him, say, hey, I know I have $50,000 in my insurance policy. You know what? I know it gets paid out when I die, but I want to help my kids while I'm alive. Is there any tax implication? And what typically happens? Yeah. So what happens is that we run the math, and let's say the client had $50,000 in the account. I might come back and say, hey, Charlie, great news. We ran the numbers. You can extract $40,000 non-taxable. So you say, great, Dave. I'm going to put a policy loan in for $40,000. We send you a check. You've got $40,000 to gift to your child. So it's a way to use assets other than, assets you require for retirement needs and cash flow.
And I can speak to that too, because I have a whole life policy on my daughter. She's 6 and we started it when she was 1. Mm-hmm. And I did this as a vehicle. So there's going to be lots of people on this call, because the definition of a first-time home buyer could be, people that are in their 20s, people in their 30s, people that have kids, people that are recently married. But if you've got young kids, this is a really great asset that you can give your children early on. Just not a big investment. Put into your RSPs, put into whole life policy. And then you're able to give your children their down payment down the road. So I know we're talking to people that are looking for houses now, but if you're on this Facebook Live and you've got kids and they're young, and this is a great way that we're trying to mitigate through you guys buying a home, to think about being able to gift your kids their down payment.
And just to kind of touch on a different point is, we had a client today call us. They have about $80,000 in their education account. So
wow,
they've done well, but the kids are in their 20s. They've saved their whole lives to put their kids through school. One of the children isn't going to go to school, and the other one basically had scholarships and had the ability to get some funds that way. Long story short, there's about $50,000 left in the account. So of the $50,000, the bulk of it is non-taxable. It's return of deposit. So I said to them, hey, if you want to, if the kids aren't going to go to school, you've already taken out the portion that's taxable, the grants and the growth. You could attack the remaining capital, and there's no tax consequence. So
that's awesome.
It's a way to use it if the kids decide, what if my kids decide to go to trade school? What if my kids decide to finish high school and get into a professional
their own
career?
Business,
So if you have that money in there, again, what you want to make sure you do is talk to the advisor, understand that if the kids don't go to school at all, then all the grant money that you've built up over time gets paid back. The growth in the portfolio is taxable, but the money you put in, the initial deposits, are all non-taxable. So
very cool.
But it's an interesting, Carey, like as you would say that, like you think about what you did, and you created your own product for your child to buy a home when she was 1 year old. That's what I think as a new parent, for any new parents out there, I think that's got to be it's now, what used to be a short-term thing is now a long-term thing. You have to, when you start having children, you have to start thinking about, developing some sort of plan for them, because I don't see the market. I don't know. I don't see the market going the other way, at least not to the extent that it was or where it was when we were into the market, right? So it's I think that's the difference now, is it is long-term planning now.
So as someone who has had a mortgage in the past but does not currently have one, can I qualify as a first-time home buyer again?
So I'm assuming this person that's had a mortgage, it was actually on title. So that's first and foremost. So if you've had a mortgage, maybe you co-signed for your brother. That's different than actually having been on title of a home and being technically that would be a co-sign or a guarantor. But if there's a definition has changed regarding a first-time home buyer. So first off, number one myth, you can only put 5% down if you have never owned a home before. That's not true anymore. If you are buying an owner-occupied property, meaning you're going to live in it, that could be up to 4 units. So you could be buying a fourplex. You're living in it. It's an insured mortgage. It falls under the $1 million category. Hopefully you can buy a fourplex under $1 million. That means that it meets the insurer's guidelines. You can put 5% down on a purchase like that. So 5% down on the first $500,000, and then 10% on anything above that. Okay. Regarding the RSPs.
I want to stop. That's interesting, because for a lot of people, that could be a vehicle for them to get into a home by having other opportunities to make income.
Right, absolutely. So anything that's, we have a lot of people that are buying properties where maybe there's something downstairs. So it has to be rentable at the time, has to have a separate suite, it has to be a suite itself, has to have a kitchen.
Right. Legally,
right. Or grandfathered. So there's lots of places in Welland where we've got some basement units, which have been there for a really long time. But regarding accessing your RSPs, you could be coming out of a matrimonial breakup, and then you would be considered under that one time, and Rob will be able to speak to that, as a first-time home buyer again, where you can access your RSP under that plan, and you can actually pull those funds out as a one-time use to be able to purchase your home, because they're giving you a break, and they changed that a few years ago.
Yeah, I was going to say that's relatively new. But yes, there is a provision under breakup that you can reestablish that.
Yeah, and again, if you're maybe the only time that you can treat a purchase, speaking about matrimonial breakups, is, as a refinance, so we can do a matrimonial buyout that actually gets treated as a high ratio purchase, meaning that there's only 5% of the equity left in the property, to be able to help maybe buy your spouse out. And then your spouse can actually use the equity from that home and their RSPs to then be a first-time home buyer again as well. So there's lots of strategies out there, and I know we're throwing a lot of information at you guys. Yeah. And that's why you kind of get together with us on a one-on-one and we hash it out.
Yeah, I think I want to just back up a little bit so that we can get clarity on what the first-time home buyers plan actually is, because a lot of people don't really understand how it works. And if there's like a government program, is it separate than an RSP program? How does it all work together? Well, I think there's a lot of misunderstanding around that.
I'm going to let these guys talk about the RRSP portion because that's definitely their expertise. If we're talking about CMHC's first-time home buyers plan, don't even get me started on it. It's sorry if anybody from CMHC's on this call, is garbage plan. It's a shared equity plan that the government rolled out. We were hoping as an industry that they would roll out a 30-year amortization for first-time home buyers for the first 5 years. That would really help people get into more home. I have not seen, out of the GTA, people don't qualify for this. So I can break it down for you. It's not a program that we utilize a lot because the government is then a partner within your home, and the 5% that they lend you, they see an appreciation on that as well.
So Charlie, just to try to jump in on that, on the RSP side of it, right? So let's assume that, and by the way, the generation that we're talking about, this 20 to 35 group, what we're finding in our practice is the investment vehicle of choice is cryptocurrency.
Geez.
That's
that's another day. That's another
that's a whole different.
That would be a really good show. We can make a compelling case.
Yeah, Bitcoin is different.
But here's my point, right? Let's say a guy, I'm talking to a client today. Let's say he's got 30. He put 10 or 15,000 into cryptocurrency. It's in his RSP. For some reason, he's buying it through a trading account. The cryptocurrency goes up to 40K or 35K, and he comes in and he says, "Yeah, I'm looking at buying a house. My dad's helping me look for something. I'm going to be using my RSPs." Great, perfect, right? My advice would be: is the minute you sign the deal and the house is firmed up and it's closed, sell your crypto, sell your stocks, sell your bonds. Move it to cash, because the problem is, this 28-year-old comes in, he's got 35K in crypto today, he's got 25K in crypto tomorrow, and then he's got 5K in crypto.
Yeah, exactly.
So once you make the commitment, liquidate it, be safe, secure it.
If I can tell you a quick little story, long story short, myself, when I bought my building about 14 years ago, I had a bunch of dough sitting in the stock market. And I said to myself, the minute I firm this deal up, the minute it's on paper and it's firmed up, I'm selling my position. So that's the prudent thing to do. So I always follow the prudent investment style, right? So I sold it. Long story short, 4 months later, I take ownership of the house, the building. I end up going back into my notes to see what the stock price was at the time as opposed to what it was today. And it would have been about a $7,000 loss. Now, it's not that big of a deal, but, $7,000 is $7,000. Now, if it had gone up $7,000, I might have kicked myself, but it wouldn't affect me buying the house. I was already set to go.
Yeah.
But if you have RSPs with your broker, with your advisor, with the bank, whatever it's invested in, great, continue down that path. But when you do firm the house up, I would suggest that you convert to cash, move your stocks into cash, bite the bullet, wait 2-3 months to close. At least you're going to walk into the lawyer's office with a check, and it's not going to be minus 10-15%.
And if you're using cryptocurrency for your down payment, please come and talk to me first, because lenders hate to track this stuff.
Yeah.
And you have to have a 90-day history on all investments. So a lot of times I'll be bothering your investor because I'm going to need a 90-day history to prove and track that down payment, because there's a lot of money laundering that happens through cryptocurrency. So the lenders are hyper aware of that. That's a vehicle that a lot of people use to launder money. So they actually don't love that for down payment. So we definitely need to strategize and make sure that we are, again, being proactive to be able to look at what you're using for your down payment and then strategize. So we're properly showing the lenders on where that money came from.
So I want to jump in here just because I want to make a few points on this. So from experience and from what we see with how fast this market's moving. Okay, so one, get your approval and everything done first.
Yes.
So that it's set, because the time that it takes to get all of that paperwork done and get it in place, you could lose what you're trying to get. It could happen. And because of that, and this is a situation that we had dealt with, or I had dealt with last year with buyers, is they had their deposit, or their down payment locked up in cryptocurrency. And because of the time it took for them to liquidate that, we ended up losing a deal because we couldn't get the money out to provide the deposit that was necessary to make the offer. The time frame didn't work. So I had to advise them at that time, look, I know that you're going to be losing some money on investment possibly with this, but we're in the process of trying to find you a house right now, and that's the most important thing to you. So you need to make a decision. Do you want to buy a house? And if you do, you need to get that money. You need to have access to it.
Because Charlie will tell you the deposit on offers aren't $5,000 or $2,500 anymore. They're $10,000. And if you're in a competitive situation, sometimes you're going to want to put $20,000 deposit on offer.
Oh,
and you need to be speaking to the other professionals in your life on when do you access that money. And that even goes back to even Simply Financial. If you got a Simply Financial account, kudos to you. I know you're trying to save the fees, but it takes 2 or 3 days to be able to get that money out of a Simply account.
Yeah.
So you want to be able to sort of keep that in mind to say, okay, I'm in a competitive situation. The deposit on offer is due 24 hours after it's accepted. How am I going to get access to that money? And I saw that problem over the holiday season where a client needed to access their funds from Simply Financial. And we couldn't get proof that the money was sort of in transit. So, again, if you're out there shopping, be proactive.
Well, I think it all goes to have your ducks in a row, right? I mean, I think now people in the market, I mean, I'm not a real estate guy, but it certainly feels that you need to be ready to pull the trigger and you got to be quick about it. And anything that's going to delay that, the potential, there's other options for these people selling homes. They're going to have other people at the, waiting to jump in, right? So you got to be ready
right
to roll.
now. Yeah,
you're ready to roll. You got to be ready to roll, right?
Yeah, you can really right now you can really tell the difference between somebody who is just doing it as a secondary income or for fun, and somebody who is a real elite professional at it. Because the elite professionals, like the team that I'm on, for example, top 2.3% in the Niagara region. Shout out to Andrew Perry, team leader. One of the best in the industry. And the reason why I joined this team, because I wanted to be with people who were absolutely at that elite level so that I knew exactly how we were supposed to do this to make sure that my clients could win, right? Because I was trying to do it on my own and trying to figure it out. And there's so much information that you need to have, and you need to be doing so many things right at the beginning and through the process. So absolutely, if you don't have all your ducks in a row right when you're going in, you don't have a shot.
So that comes like, okay, where's my down payment coming from? I'm going to strategize. I'm going to talk to my financial planner. I'm going to talk to my accountant and talk to my parents. I'm going to get pre-approved and not some garbage pre-approval where you're online 60 seconds. And what do I qualify for? And that's not going to hold any water. So you need to come to a professional. Like on my team, we fully underwrite your file and review all your documents and take a look at your down payment so we know where it's coming from. And talk to your co-signers, and we have all of our ducks in a row, and we are ready to pull the trigger when you guys are, when you get that winning bid, right?
Coming back to the co-signer, making that comment, I was thinking about this earlier when we were speaking about it briefly. We're even dealing with it right now in the office. We have a listing that's coming up, and it's a father-daughter selling a property. And she bought it, I believe, just a couple of years ago. You can't really disclose too much, but and it's right in that perfect situation where it was the father helped to get the first sale, and now there's so much equity there that they've built up that she's not going to need that assistance in the second purchase, right? The equity was there, and now she has that vehicle necessary to branch out and do it on her own and make that transition.
And I'm sure, like, as a real estate professional, like, I am coaching people. I know you want to buy North End St. Catharines, or you want to buy, I get it, trust me. But sometimes what you're gonna want to do is like look outside of those areas, and maybe you're buying in Fort Erie this year, or maybe you're buying in Fort Erie for 2 years or 3 years. And then we're taking a look at it, and you're talking to your accountant, you're talking to your investment advisor, and maybe what we're doing is we're pulling the equity out, and now this is a rental. And then you start to build some wealth there, right? And you're pulling the equity out to now buy that property in St. Catharines. So sometimes your first property is a semi in Fort Erie, and that's okay. And that's how you get into the market. So I know there's a lot of frustration here. I have buyers that are missing out 10, 15, 20. It's just stay in it for the long haul because the market is not going down. We have a supply issue.
So last topic, unless you guys have something to add there. So last topic on the first-time home buyer is something that is commonly overlooked, I'm finding, is the ability for first-time home buyers to get into pre-construction. Because right now we're seeing pre-construction is one being used as an equity vehicle, right? A wealth building vehicle, but also a lot of the short-term builds that are popping up, if you're renting or if you're still living with your parents, you're in that prime opportunity to get into a pre-construction because you don't have a mortgage. You're not trying to bridge a mortgage. You're not trying to do any of the fancy footwork. You have an opportunity to do the things necessary to get into your first home as long as you can afford it.
100%. So if you're looking at pre-construction, first off, you want to be able to take a look at a few different things because life happens during these pre-construction. So, if you're looking at a condo, say in Toronto, and you're like, I'm going to get in on the ground floor, which is amazing. First off, can you make all of the builder deposits that are required to be made? What's the strategy for that? Secondly, if life happens and you need to assign the sale, can you assign the sale if you need to get out of it?
Yep.
And then lastly, what is that going to look like for you down the road? Are you going to be quitting your job when it comes to close? Or maybe you've lost your job and what is our plan B? So we want to talk to you about the risks that are involved. Pre-construction is a great way to sort of build up some equity, but what are the risks involved in possibly entering into that? And what is our plan B? Because there's always a plan B. We're not we represent major big 5 banks, all of the credit unions, private lender, monoline lenders. I don't want to bore you with all the, but we say we probably have 100 something lenders. I haven't looked at all of them, but we deal with primarily about 15, and then we specialize in alternative lending as well, just in case you get into the hot seat on a
creative lending.
Creative lending. Yeah.
Did you have anything to add to that one?
No, I appreciate that. I think your position, Carey, allows you to do that. I mean, it allows you to get creative. You have different, you can access different markets. You can combine markets. So I've seen it firsthand. It works great.
So sometimes with pre-construction, we can actually use the escalated value of the pre-construction valuation on the property as the current value, which it almost makes it into like a bit of a refi situation where you're able to sort of access that equity on close to be able to help towards your down payment. But again, you want to make sure that you're going to be able to hit those builder targets by making sure that you're making all of those deposits.
Yeah, I would say, I think a lot of first-time home buyers, they just look past that opportunity because there is a lot involved. It's not a very simple cut and dry situation where I go online, I go to realtor.ca, I look at houses, I find 5 I like, I go look at them, I put an offer in. It doesn't work like that. There's a lot more meat to that bone, and it takes a lot more time and consultation, which is something I feel first-time home buyers are just looking past because it's a lot of work. Well, and there's a lot to be scared of.
Yeah. It's not, they don't feel like they're knowledgeable enough to get into that space. And that's where a good team, and you might want to bring in a builder that sort of talks about sort of like that pre-construction model.
We've definitely thought about doing that.
What that looks like, right?
Yeah.
And talking to them about, what the obligations are, and then having a really good realtor on your side that's going to be able to review that contract as well as a lawyer. I highly recommend that if you're going to be in pre-construction, that you're having a lawyer review the contract before you're waiving conditions.
Absolutely.
Yeah, good advice.
Okay. Well, we have about 10 minutes left before we're going to shut it down. So we'll just open it up. We've covered all the questions. I guess the comment that I would like to make, we started with the 5 biggest hurdles. And in the 5 biggest hurdles, what we saw there's a few things that are not controllables, things that we have really no control over at our level, at a micro level. And then there's a few things that we do have control over. So affordability, there's very little that at our level we can really do to control the affordability of a home. That's kind of controlled by the market at this point. And it is a little bit, it's a lot going up. Let's be honest. It's going up fast. We're at about a 25%, 26% increase in the average value from December to January.
Wow.
Yeah, that's what we're seeing right now. So it is leap and bounds.
In all types of homes or just
single family dwellings.
Okay.
Yeah. Mainly bungalow style single family dwellings, but to get really granular. But yeah, we're seeing a big jump. And again, it's just a supply issue right now, right? Yeah. And the lockdown and all these different things that have kind of contributed to that.
Interest rates.
Yeah. So people, there's a lot of people into the market. There's a little bit of inventory. We will see a lot more inventory come up with the spring market next month. Yeah. So it will open up. We will see some things improve. We will see a bit of an inventory bump.
So quick question. So you look at what's happening with inflation. There was a big announcement yesterday, Bank of Canada, mortgage rates and so on.
Yeah.
You know, part of me thinks that there's a supply issue because, you know, everybody owns 5 houses. You know what I'm saying? Like that's a bit of a, you know, real estate properties. I mean, it's cheap money. Cheap money's been there for the last 4, 5, 6 years.
Yeah.
Tough to not pull equity out at 2% and buy a few rental properties. But do you guys see that the interest rate change potentially is going to impact some of the, like you start to look,
I got a different angle on that actually.
On the investment side, not on the personal purchase side.
Sure.
No, because the interest is tax deductible. Yeah. So that's part of like, you know, one of the advantage. Variable rate is still crushing. Yeah. So a lot of my investors they buy with a 30-year variable rate mortgage, right? And then they're writing off the interest anyways. And that's just like a write-off to the income. Yeah. So for me, I don't think that. I know a lot of people, you know, we saw very, very low rates in the beginning of the pandemic, and now rates are starting to rise a little bit. And everybody asks me, like, you know, where's my mortgage crystal ball? Where do I think the rates are going to go? But this is what I can tell you. When we saw the, like, you know, first sort of big boom in Niagara, rates were at, when the stress came in, they were at 3.5%. Yeah. So I have some of my, you know, 5-year renewals that are coming up, or they're renewing a little bit earlier because rates were at 3.5%, and people were still buying houses. Yeah. It's still below 5%. And you and I talked about this, still cheap.
Yeah. Carey, can I ask you, again, I get to the point where where's the affordability kick in here, where I get it if you're a professional, you're a doctor, a dentist, a lawyer, you're a professional person. But, you know, this isn't Toronto with, you know, 6-figure paying jobs. I mean, casino incomes and factory incomes and, you know, this is not a, you know, I don't know, what's the average income in Niagara, 50 or 60,000?
Yeah.
But again, looking at homes that are $1 million, $1.2 million. Yeah. Not that that's an entry point for a person in their 20s, but maybe even the second house, you start looking at it going, wow, at what point is the affordability becoming
for a rental, you mean?
No, even for a person just to own another home. I mean, at what point, you know, if incomes were to follow the price of real estate, we'd be paying everybody $30 or $40, $50 an hour, right? But we're still paying $15 to $20 an hour. I mean,
yeah, there's a lot of factors right now. So one factor we need to focus on is that in Niagara region, we are in a tourism industry-based environment. So what we have in Niagara is, the latest report that I saw is we're at between 5 to 7% of the homes in Niagara are short-term rentals. That's actually a large number when you start to think about that. Those are basically vacant homes that are being rented out for people like on Airbnb and different companies like that, right? So that is just, it's a small part of it, but we have, you know, all of these different smaller things that amount to a big problem, right? Yeah. So, you know, that's one issue. We have a lot of people moving to Niagara because the quality of life here is incredible. Right. Let's just call it what it is. There's a lot of people, we get contact from Toronto realtors, Toronto people looking to move down here, trying to find homes down here, trying to work with us.
You've got the work from home situation still rolling
exactly.
out, right?
You know, it's something that has been exacerbated by the pandemic is the realization that the Niagara region, living in a place like Niagara is a fantastic thing if you can work from home. Mm-hmm. This is a great place to live. So instead of living in Toronto and having a $2.5 million mortgage on a 650 square foot condo, you know, you can have a really nice property here for much less than that, right? And if you're working from home, you're working from home. Right. Yeah. The quality of life here is fantastic. So we're seeing there's a lot of demand for our area, and that's a big issue. Then we have, you know, another issue, like I said, with the Airbnb and the short-term rental situation. Then, you know, there's just many, many different issues. Mm-hmm. And we have an aging community in Niagara, right? But there's really nowhere for them to go right now. We don't have a lot of retirement buildings in the area. They're full. Most of them are full. Right. So there's just a lot of different issues that we have to deal with. And I don't want it to there's all these different things. There's inventory. There's a lot of inventory coming. We've been talking to builders that have been building units, and there's a lot of planned builds happening for Niagara. So there's going to be a lot of inventory coming to the market this coming summer. something to really look forward to.
But first-time home buyers are getting houses. They are
Yes.
winning bids. I can tell you guys that.
Yes.
Like, I know that it feels overwhelming. I know that it feels like you're not going to get a place. But honestly, you just need to, it will come. It will come, and put a good team around yourself. And like, let's talk about what you can afford. And like, really, what is your budget? So it's always budget first for me. We give our first-time home buyers an Excel spreadsheet, and we're like, fill it in. Don't forget to add your Netflix account. Like, I don't want you living on goldfish crackers at the end of this. So we want to talk about what's affordable, but the average rental rent right now is more than what a mortgage is.
Yeah.
So, you know, if you've got good parents behind you that are going to co-sign, you've got some money saved up, get in touch with us, get in touch with a realtor, and like, let's work through the numbers, because I will work with you for years until you buy that first house. But not getting into the market, I think, isn't an option that people should lead with. Like, I know it feels like the affordability is it, you know, but it's not going to go away. It's going to be there next year. So
I agree with you, Carey. I mean, I think you just keep plugging away at it and be committed to it and work with good people and don't get discouraged by it, and you will get something that eventually you'll surprise yourself. Something will come. You'll say, "It happened."
People will win. You know, my daughter just won a successful bid on her property, and I didn't think she was going to get it. I'm not going to lie. I'm like, oh, she's not going to get it. And then I was like, oh wow, this is happening. But
like anything else, it's hard work, right?
Yeah, absolutely. And we will go to the ends of the earth. You know, we have some first time home buyers that worked really hard. They worked a second job. We worked with them to help them build their affordability and taught them what they needed to do to be able to qualify for a mortgage. And I wrote a letter. And I'm not saying that, but it helps. Like,
but that really is what it is about, though. And I think that is missed. You know, to wrap this up, is that communication is key.
Yep.
And the reason why I wanted to bring you three in here is because you're leaders in your industry, right? I want to facilitate, if nothing else, I want to facilitate people being able to have access to getting the services and the resources they need to get that team around them so that we can help these people fulfill their goals and their dreams. Yeah, right? That's what's fulfilling to me, is helping people get into a house, helping them achieve that, and seeing them get the keys. Oh my gosh, it's one of the most fulfilling things you could ever do. Yeah. It's so rewarding, you know, to see that smile on their face, that exuberance, that excitement. And to do that, it takes a village right now.
And parents, and parents feel the same way too. Like, they're talking to their financial advisors, they're talking to their accountants, they're talking to mortgage professionals or their bank, and they're saying, what can I do to help support my kid, because I don't want a tiny home in my backyard, you know, because really, what is the option? You know, stay at home, save your money, do not buy an F-150, meet with a mortgage professional, talk to your financial advisor.
Or a Dodge Ram, or we're not picking on Ford.
But there is hope.
Yeah, no, that's well put. I think you're right. I think just keep going at it, and I think as parents, I think they finally realized the problem that their kids may never leave home, so they're probably motivated.
They're motivated
to help now. Yeah. Well, thank you very much for coming, guys. Really appreciate you giving us your time tonight.
Yeah, that was great, Charlie.
Awesome.
Yeah. Awesome. Thanks so much.
And Dave and Carey.
Thank you.
Yeah, absolutely.
Thanks.